Some interesting top picks this week from our panelists here on the stock scene. John, you've got a real interesting one that you pulled in with here. So interesting, I can't even pronounce the name. SID is the ticker symbol. They're a Brazilian steel producer.
Correct. I'll try to pronounce it. Siderurgica Nacional Companhia, which is somehow gotten to SID, which is nice because SID's a nice name to throw around, and it's been a really good stock for an international trader. And the reason is that it was at $2.50 a share in July.
Oh.
And 2 years ago, it traded at $16 a share pretty consistently. It is actually one of the very largest, if not the largest, steelmaker in Brazil, and it's an integrated iron ore and steelmaker, meaning it makes its iron ore, it ships iron ore outside of the country, but it also makes its iron ore for its own steel, which is 77% of its business, which is domestic Brazilian steel. So it started its uptrend from that incredible low, and it's now at about $5.50 a share. And it's very easy for this stock to double on the way up if the earnings momentum is there, and we are seeing that. We're getting in the ranking system to come up with a 1. And then we just saw last week, there was an London Metal Exchange conference in London with 10,000 traders, and the bullish outlook on steel and all other industrial metals came out, and they moved up the outlook for SID from 5 cents annually for the stock to 30 cents and 20 cents next year, which will come up too. I think the stock can do, it did almost 20 cents a share in the last quarter. So you can easily just get on a flat profile 80 cents a share, which is more upgrading from 30 coming forward in a $5.50 stock that's got 80 cents a share in earnings. And it actually pays 20 cents a share in a dividend. Wow. And they haven't gotten rid of it. So you got an income stock, and it's dirt cheap. It's a value stock, and it's a momentum stock because it's coming off the bottom in July, and you've got a Zacks rank of 1.
What more could you want, right?
Right.
So apparently there is more than just a lot of coffee in Brazil.
Yeah, exactly. And then add in the real, which was, they have labor cost issues and inflation issues, but the real blew up, which takes your cost advantage, and you're in a very cost-driven business. You all got a 20% advantage. You're all domestic. You can sell abroad easier, and you can protect your markets better.
Okay, good. Thanks for that. Todd, you have a drug company, Lannett,
yeah.
LCI, the ticker?
Yes, that's right. They're a generic drug maker, and they produce drugs up and down the spectrum for all different types of things, but they're not over-the-counter. They're prescription only. But they've been around since 1942, still a small capper. They have a market cap of about $645 million, but fantastic earnings momentum here. They've delivered 6 consecutive positive earnings surprises, and over the last 4 quarters, if you look, they've delivered an average beat of 96%. So fantastic earnings momentum here. After their latest beat on September 10th, analysts revised their estimate significantly higher, sent it to a Zacks rank of 1. It's currently it's pulled back a little bit. It's a Zacks rank of 2, but that's still a buy rating. So fantastic earnings momentum here, and analysts expect tremendous growth for this company over the next several years. And if you take a look, they've had tremendous growth over the last decade, of over 20% compound annual top-line growth, and they expect that to flow through to the bottom line going forward. That kind of justifies their premium valuation. They trade at 31 times forward earnings, so that is a bit rich. But again, considering the fantastic earnings momentum and the solid growth potential and generic pharmaceuticals in general, I'd say that premium's justified, and there's a lot to like about this stock.
All right, Tracy, Chinese real estate company.
Yeah, eHouse, China. I think I've talked about them before. They're like one of the few Chinese companies I do like to talk about. They are kind of like a brokerage company, like a Coldwell Banker or Baird & Warner would be in the United States, but they also have like this whole new e-commerce side. They do property management. They're in all areas of real estate, and real estate is on fire in China. Last March, the government tried to kind of cool it off, and they put out some new, requirements on mortgages and things like that. It did for a little while, but now they've really backed off. And, the word is out there that they're not going to try to cool it off again because the economy's slowing. Got to have good housing market to kind of boost morale there. And we saw in the September numbers, the Chinese house prices in the 100 largest cities was up 9.5% year over year. It was the biggest 1-month gain since December. The actual housing sales are up 35% in the first 9 months of the year. So, it's going gangbusters. The developers are getting loans. I think the loan amount to new house builders was up about 50% in September. That's huge. So they're pumping the money into the the construction industry now, and these guys are kind of at the center of it, and you can see it in their earnings. They are Zacks ranked #1. They're supposed to grow earnings 146% this year, another like 113% next year, but they're not cheap. They're trading at like 54 times. It's pricey, but the story's there with the growth. If the Chinese government comes out and tries to squash down the housing market again, you could have a little bit of difficulty in this stock. But right now, as I said, the rumors are that they're not going to do that at least through the end of the year. So housing in China is a good place to be.
All right, thanks all for that. More stock picks and stock picking strategies on Zacks.com, our website. Link to them right off the homepage, and check back often because they change often. With everyone here, I'm Terry Ruffalo.